Andrew, you have reported a very strong set of numbers this morning. What are the key highlights of the year and what's driven this performance?
Look, it's been an unprecedented 12 months for all of us. But despite that, the portfolio and the company have performed extremely well. And I think that's testament to the portfolio that we've created. We've managed over the year to increase our rental income. That's up 6% to £123.3 million. We've increased our EPRA earnings. They're actually up 15% to £85.6 million. And that's courtesy of the increase in rents, but also a reduction in our financing costs. That's allowed us to announce an improvement to our EPRA earnings per share, up to 9.52 pence, which in turn has driven another progression to our dividend. So our dividend for the year at 8.65 pence a share is up 4.2%. And the revaluation of the portfolio has delivered a 12% increase in our NAV to just over 190 pence a share, courtesy of rental growth, but also some yield compression, particularly in our logistics investments, and more particularly in our urban logistics investments. So overall, it's we're in good shape, and even taking into account the environment that we've all had to operate in, it has been a very, very strong year for us and also for our shareholders. And our confidence for the forthcoming 12 months is similarly high. We announced this morning, a 4.8% increase in our Q1 dividend for the current financial year, and that's testament to how we think the portfolio is going to perform, but also of how the returns that we're going to generate from it going forward. I think we've got a very strong reopening economy, and we're seeing good demand for our assets, and that's something to be extremely optimistic about.
Turning to your operational performance, can you provide some more detail on what's been achieved in the period?
Well, if you think about a period, like I said, it was unprecedented in where we've endured 3 lockdowns. We still managed to execute 173 different asset management deals, over 100 lettings and re-gears, 72 rent reviews. That's delivered £5.3 million worth of extra income, a like-for-like income growth of 3.1%. That's an incredible achievement in lockdown. But what it does do is it highlights, I think, the enduring strength of the assets that we own. We're in the right sectors now, but we also are increasingly owning the best assets. So that has been one of the highlights. On the investment side, we've done over £400 million worth of transactions, both buying and selling over the period, again to fine-tune the portfolio. Owning a portfolio that is fit for purpose, you still need to exercise, and we've done that. We've sold out of some of our non-core sectors. We've sold 3 more office buildings. We've sold some retail assets, and that's been largely invested back into the urban logistics space. So very pleased with that. And then finally, the financials. We've refinanced £780 million worth of debt. That's given us a big debt saving on our interest cost saving on our debt. The average cost has come down from 2.9% to 2.5%, but also equally importantly, we've increased the maturity by 4 years. Our debt it's very, very long. We have a very strong real estate portfolio, and we have that is supported by some excellent debt metrics. So you put those 3 together, and in some ways the numbers then automatically come out of that.
And how has the development activity progressed during the year?
Yeah, again, despite the backdrop of certainly lockdown 1, not having to take people off site, it's been good. I mean, it's been focused around our 2 main sites, one in Birmingham and one in Bedford. During the period, we pre-let the last phase of our Tyseley development to Amazon on a new 15-year lease for their latest state-of-the-art urban logistics facility. And we've designed that obviously in tandem with Amazon, so it's capable of supporting a fleet of electric vehicles. So that's terrific. You know, we're very, very excited. Can't wait for that to open in the summer. And then at Bedford, after successfully completing and letting the 3 buildings in phase 1, we've now completed building out Unit 2, which is just over 170,000 square feet, and we've agreed in terms now to lease that. And those terms have been agreed, you know, above what we thought we would, the rent we thought we would achieve this time last year. So that's a real positive, and that confidence has given us, you know, helped with the decision to proceed with the last building, which is the building out of Unit 1, which is about 350,000 square feet. We're on site with that now. The steels are almost up, and we've got one very serious conversation ongoing, but we also have 2 others in the background. So it's been good, and you know, we look forward to those completing and obviously generating, you know, future income, and that will help propel earnings growth for the next year or 2 as well. So it's been good. It's been good.
You referred today to aligning your portfolio with the winning sectors and the strongest assets. Just going into a bit more detail on the investment activity, what have you done to improve the portfolio quality and construction?
Yeah, it's a good question. I mean, look, we have this motto internally called "It's about winning the losers game," and you know, we run the winners, and they contribute, you know, brilliantly to our returns. And you know, one of my jobs is to identify with the team the losers, the ones that pull down the portfolio, and to deal with those. We've seen, you know, really good liquidity return to the real estate market over the last 6 months or so. That has enabled us to sell out some assets where we think future returns will be more muted. So we have mentioned earlier, we sold 3 more office buildings, you know, and we're pleased that we've got out of that. You know, office is a non-core sector for us. We've also trimmed our investments in long-let DIY investments. You know, the DIY market's had a very, very good COVID. You know, trading performances across B&Q and Wix have been very, very strong, and hence investor appetite has improved. So we've sold some long-let retail assets and DIY assets that's been good. And then the reinvestment, as I said, has largely been into, I mean, our strongest conviction call is urban logistics. We announced last week the acquisition of two buildings in London where we've subsequently executed lettings to a dark kitchen operator. You know, that's an exciting area for us. It's an area we've done a lot of research into, and we partnered up with an operator who we think is one of the best in the business, and we're hopeful that we'll be able to roll out more of those type of deals, you know, over the coming months. So you know, it's allowed us to get the market over the last 6 months, allowed us to get out of some of the legacy sectors that we don't want to be in, or legacy assets where we've taken our returns, and reinvest into new growth areas where we think we're going to see some, you know, superior rental growth over the next few years.
This morning you referred to grocery, logistics and healthcare remaining the standout performers. What's your current thinking on the outlook for these sectors?
Well, look, you know, the logistics market is, you know, as a number of the temporary behaviours become more permanent, and they become more ingrained in how we decide to live, shop and socialise, I think you'll continue to see terrific demand for warehouse accommodation across the United Kingdom. You know, I think a number of, you know, consumers are increasingly wanting, you know, instant gratification, and that means, you know, companies serving the consumer need logistics infrastructures that are closer to where they live or work. I think that other parts of the logistics sector will benefit from a number of operators moving to just-in-case logistics strategies, not necessarily just in time, and that will mean more stock being stored on the island of Great Britain, you know, to try and minimise disruption caused by the closure of the Suez Canal, Brexit, you know, border controls, trade war with China, you know, weather conditions, whatever. So I think that will continue to fuel demand. And then the other conviction call we have obviously is in long income, you know, particularly the grocery convenience sector, which again has had a very good inverted commas COVID. You know, the more time we've spent at home, the more food we've consumed, but also the more money we've spent on our homes. and therefore that lends itself to us allocating capital into long let grocery and also trade and triple net retail assets in those particular sectors, and we think that where we see value we will add to that, but we don't have a target. We don't have a target, and it may be that we always take a dispassionate view of our assets, so it may be that we sell more of those than we buy in the coming period, but it is a sector that we think offers some some good opportunities, but like I said, we don't have a target.
And finally, looking forward to the next year, what's LondonMetric's focus going to be on?
Our priorities are to run our winners and sell our losers. That makes it a lot easier. We've made the macro call. I think we've got most of those right. And now it's about not only being in the right sector, but also owning the best assets. And for me, the best asset is one that delivers a reliable, repetitive and a growing income. So I like long leases, I like strong credits, and I like progressive rents. And if we can find opportunities that we think are, that deliver those at the right price, then we will, continue to allocate money to them. I think that, compounding income is just a wonderful formula. And I think if you get it right, it is the bedrock of successful investing over the medium and long term. It really is.